register. So is it clear? Any questions? Any question before we start? Is it clear to you guys? It's okay. All clear. Perfect. So I think it should be fine. So everything you know should be if you review your problem set, reread a little bit some of those again, and then I will prepare probably additional exercise if needed, and then I will use that session to recheck your readiness for the exam if you're still not ready. So in that case, you can still have some few more days to 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 clarify all those unclear issues for the exam. Okay, and then I will explain at that time how the exam would gonna look like, but I can give you a little bit more some kind of idea. So usually I can probably prepare the exam online version that you should have like two main parts. One is about more conceptual questions, and some are or majority will be the calculation, like we do it in the problem set. Okay, you also have some more exercises in the textbook. If you have time, you can try that, and then and then this you can have some conceptual questions, and then probably I can make a kind of true and false for conceptual questions, and then the calculation, okay, for analytical questions. Okay, I tell you on 29 how many questions you may have and how many calculation you have, and therefore I can also put in place whether we can do it randomly and change some of those to have different figures to avoid cheating. When you do online exam, we need to well prepared, so everybody should not see the same question at the same time, and then so on and so forth. Okay, I explained all that when we set everything in place. All right. Okay, last time we're talking about the payout policy. Remember, the payout policy, you have the choice to plow back for future investment and to pay out to the shareholders. Okay, if you decided to pay out to the shareholders, you have two ways to pay your extra cash or excess cash that you want to distribute to the shareholders. One, you can pay dividend. Okay, the dividend is involuntary. It means the shareholder has no choice to receive it when the company decided to to pay a dividend. Otherwise, you can do the company can do what we call the share repurchase. The share repurchase, you can participate all those share repurchase. Okay, so that is also another way to distribute cash back to the shareholders. Okay, in the form of share repurchase. All right, so and then we talking about that in the way of doing share repurchase, the stock price should not should remain unchanged because the number of share outstanding reduce proportionally to the cash distributed. So therefore, the share price values, okay, stay at the same price before share repurchase. okay, where the cash dividend, you know, the stock price should drop with the amount of the value distributed to the shareholders. All right, so the size of the pie becomes smaller, right? And then you have in the world without taxes, Marty Miller should apply that where they propose that no matter you pay not pay out the dividend, the value of firm should remain unchanged. Again, without in the capital perfect capital market where there is no tax and other, the choice between doing paying cash or share repurchase should remain, should not affect the firm value as well. Okay, so therefore, if the company decided to do share repurchase, you need cash. What you can do the homemade dividend. If they pay dividend, you don't want to get cash, you can use those dividend to buy more shares from the market and hold you know, shares you know, more in the company. All right, so either way the result should be the same. Okay, and then obviously in the literature or in research we are also you know, discussing what are the possible theoretical explanation why some firm prefer to pay dividend, some prefer to pay capital or to do repurchase or the mix and so on and so forth. Okay, and then we have also you know, the idea of paying cash or paying doing a charity purchase should matters only if the tax that you know, used to apply with the cash dividend may be different from the tax apply to share repurchase, which is the capital gain, right? So some countries, the way we treat the capital gain tax and the dividend tax may be different. Okay, when are they different? So therefore, investor may prefer one method to another. Okay, one way to another, either the the share repurchase then the cash dividend, because in on average people or country, they tax more on the dividend than the capital gain to promote capital market. So therefore, but the puzzle that we have is like companies still pay dividends, so we have kind of theory of dividend clientele because of the investor like to have the cash dividend or receive the cash dividend when they invested in the shares or in the stock market. Okay, so let's go to the question to ensure that you understand well. We have what we call the problem set. See, I can share the screen. Okay, so suppose you see my slide. Do you see my document? You see? Do you see the problem set? Question number 17. Yep. No? Do you see it? No? Still? Oops. Why cannot? Can you see now? Yes? Yeah. You see it now? Yes. Okay. Perfect. Suppose the company Barbara Bill has 2 million in excess cash and no debt. The company want to use its excess cash to repurchase shares. Okay. You know, the company expects to generate additional free cash flow of 4 million per year in subsequent years. Assume the company unlevered cost of capital is 8% or company cost of capital. The company has 2 million outstanding shares. What will be the share price of the company be just before the repurchase? So what you have to do is to calculate the total value of firm. Okay, what is the total value of the firm? You have 2 cash, 2 million, and the 4 million per year over the year, okay, without growth, right? Because this one is for free cash flow, 4 million per year forever. So we can apply perpetuity formula where the value of the assets, okay, without cash would be 4 divided by R minus G. So G is equal to 0. So we can have 4 divided by 0.08. So therefore, the value of the firm from these additional free cash flow starting from year 1 would be equal to 50, right? This 50, oops, I can show you here. This 50 together with the 2 of cash. So before the share repurchase, the market value of the company should be 52 if we have 2 million share outstanding. So the share price before share repurchase should be 26 euro. What will be the share of the company be just before the repurchase? The answer will be going to be 226 euro, right? So how many shares, okay, will be repurchased? Okay, obviously you're gonna use the market price of the share, which is 26. So you want to use 2 divided by 26, 2 million of 26. You're gonna do the amount that you're gonna be repurchased, which is 76,923 shares. 2 divided by 26 goes to 76.92 or 76,923 shares. Okay, what will be the share price of the company be just after the repurchase? So if you take the value of 50, you have 1.9300077. You can get the share price of 26 euro, right? So the price, the share price when you do share repurchase should remain unchanged and it's gonna be 26 euro. If you hold 1,000 share of the company and you want cash, and the company decided to do share repurchase, what should you do to raise cash after the share repurchase to get the same amount that you would receive if the company pay cash dividend? So no calculation is required. It's just only you make the homemade dividend, sell your share to make the homemade dividend. All right. So the dividend payout policy is very straightforward and simple. In the exam, you should get, full on this module, right? So is this okay? Any questions? Yes? No? If no, I gonna make the next session, which is about the long-term financing, which is gonna be the last one. Up. So the long-term financing that I'm going to take opportunity to discuss with you today is about the, a general overview. What I propose today, maybe we try to finish without break. So because this session is quite short and quite descriptive, so therefore we can probably finish in in 2 hours without break, so that we can have less we can finish our class earlier. Okay, if we don't have break. All right, we can just go straight. This is okay, because you won't be tired, because it's very quite descriptive. It's okay. We don't have break, and then we go until we finish, so that you can finish our session earlier than usual. Agree? Okay, so the equity financing, I'm probably going to talk a little bit, and then and introduce you or show you some of those startup which is become more and more common in today for those high-tech firms, how they price, how they raise financing, what are the process, how that affect to each round of financing, and so on. Okay, so this is about the chapter 23, where I simply will introduce you. You can read more in this chapter 23. So we can talk a little bit how we do an IPO for the people who have never done any capital market. And then you have seasoned equity offering. SEO is one after you do the IPO. If you want to issue new equity, we can simply call equity offering, or we can call seasoned equity offering, mean that the equity offering which is not the first time, because the first time we call an IPO, and second time, third time, fourth time, and later on we call seasoned equity offerings. Okay. Some people may know about, for example, the loan that you use for securitization. Okay, we often use the seasoned mortgage loan to securitize and to issue a particular type of financial security. So we use seasoned mortgage loan, the mortgage loan where the borrower already paid, already, repay back the interest and some amortized principal over time. You can pool those seasoned mortgage loan together and issue something called, for example, MBS. Okay, we securitize it, and then we issue the mortgage-backed security. Somebody know what's the MBS? Last time we do the LBO. What is the LBO? 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 It's a leverage buyout. Okay, the leverage buyout where you borrow a big money from the banks, and which is the many of the PE firms okay, use a big amount of borrowing together with some equity provided by these PE funds to make acquisitions of listed or non-listed company. Okay, and then they manage the private equity firm manage those acquired company for some years, and then they exit. Either they exit obviously with a higher price to other company, or they can do an IPO, okay, and make it available and listed in the stock market, and repay those leverage to the bank that they borrow. Okay, so we have LBO. We had also the MBO. Do you know what's the MBO? Somebody know what's the MBO? You see some kind of these question I may ask you in the true and false conceptual questions. Huh? What is the MBO? Somebody know? Somebody know what is the MBO? Management buyout, right? Instead of doing or made it by the PE firm, the group of management team, they can make an offer and acquire the a company where they work for, okay, from the existing shareholders. Okay, so this one we call the management buyout. Okay, and then we have another things we call MBS or ABS. Anyone know about MBS or ABS? What is the MBS? Mortgage-backed security. Very good. Do you have mortgage-backed security in Vietnam? Who issue MBS? The MBS is what? Is an equity instrument or debt instrument? No, you don't have MBS. Let's assume that you know the MBS. MBS is very common in the US, okay, and this MBS is play very important role in the crisis of 2009, okay, where many of MBS use the subprime mortgage loan to back up this security, and then these subprime loan that used to back these security, okay, to turn to be very bad. So investor who hold these MBS, okay, make a big loss on holding these MBS. Okay, example of Lehman Brother. Okay, that's why these Lehman Brother went, bankrupt. Okay, and so on and so forth. That is generated. That's why sometimes we call the subprime crisis. Somebody know what is the MBS? MBS is the debt or the equity instruments. MBS is debt, okay? It's like a bond, okay? But this bond is not like a plain vanilla coupon bonds, but the bond that exactly amortize like the cash flows that you put it in these securitization process. Okay, somebody know what is a securitization? Securitization. Somebody know what do we know? You know, the mortgage, we transform mortgage, which is generally long term, to the MBS, which is you transform illiquid asset to liquid asset, we call securitization, right? And who often issue this? Who are the MBS issuers? So if the debt, so is a bond, meaning that someone issue the bond, right? Who is the MBS issuer? Who issue the bond? Who issue the MBS? Anyone? I get bonus points. Someone know who is the MBS issuer? Is a corporation? Who actually own mortgage? The obligor who own the underlying bond. Real estate? Yes? No? Almost. Who issued the MBS? Investment bank? No, it's not the investment bank. Who own mortgage in general? So let's talk about the MBS. Who own mortgage at first? Who own mortgage? Who own mortgage? The banks, right? The bank lend the money to the home buyers, right? To the borrower. The borrower sign a mortgage loan with commercial banks, with the mortgage banks or commercial banks. And the loan has a term, can be 15 year, 20 year, 30 years. So I bought this apartment not long time ago, 2 years ago. I get the mortgage from the commercial banks. Okay, I have 20 year. I choose my 20 years maturity. In France, we often the very common one on the mortgage is the fixed rate. Okay, we can use the floating rate, but not very common. The most common one is the fixed rate. Okay, so can you imagine how much the bank charge me? What is the interest on the mortgage, on my mortgage loan? Can you guess? Not only mine, but it's only to give you some idea about the loan market in France or in developed country. Mortgage loan interest rate, fixed rate for 20 year maturity. Okay, is amortizing loan. Somebody guess what is the interest rate we charge? How much you pay if you're going to buy a new house, and then how much you're gonna pay in Vietnam? Assume that you are a good borrower, okay? You are prime customer. How much they charge you? 11% approximately. Okay, good. You think that how much I pay my amortizing loan? About 9 to 11%. Okay, so how much the mortgage loan I receive? I can give me, but it's not only me, but I can give you because I have my experience directly that I got it not a long time ago. I pay, somebody say 3%, other. It's a fixed rate, no? I'm not talking about, it's not floating, it's fixed for 20 years. I pay exactly the same interest rate for 20 years. Any other guess? You think that I pay 9% like Vietnam? 5%, 2%, very close, 2.4 to 2.7. I pay 1%. So 1%, if I borrow right now, I think I can get 0.8 or 0.9%. Is 1% because it's already 2 years ago, 2 years ago, is 1% fixed rate I pay on my mortgage. Wow. Ji Chundong Guyen said, wow, very good. That is give me a debt capacity to borrow more due to the interest rate is very low. So this is a kind of phenomenon in advanced economy this day, okay? Because that's why boom financial crisis, the house pricing in France is quite expensive, isn't it? It depends. Yes, is it true that in Paris, the apartment, the price goes up from the last, few years, but it's always like that. If you have a nice area where you have Eiffel Tower like mine, you can imagine. I think the price right now is, this is a very good area. You can think about, I can guess, I haven't checked recently, but you can probably, it's about 15,000 euro per square meters. This is a very nice area, but if you go to other area, you can probably pay between, 10,000 or 11,000. That is kind of like Paris price, which is still cheaper than London, but it depends, right? They have different, it depends on your house that you buy and so on, but this is kind of the price. Okay. All right. So who owned the mortgage? So it's the mortgage banks. Okay. Since the mortgage bank provide or has the loan, that they have the contract, that the buyer, okay, sign a contract, and they're gonna have, long-term maturity, which can be 20 years. Okay. Banks has, you know, bank has a bank has the mortgage loan, which is illiquid asset, right? Illiquid asset, because the maturity is long. Okay. To transform this mortgage, the banks are, any financial institution, many of them, they are financial institution. They set up a kind of SPV. Somebody heard about the SPV? Again, I have a lot of abbreviation. Do you know what is the SPV? Is the special purpose vehicle. Okay, I can have the special purpose vehicle who gonna buy a pool of mortgage, which is often the season mortgage that have some historical records of the payment, the quality of these financial assets, right? Loan is financial assets. And this season mortgage, when you pull like thousand of borrower, thousand of mortgage together, some of the risk may be diversified and so on and so forth. You sell it to the SPV. SPV, we're gonna finance these purchase of season mortgage from the bank by issuing bond, right? They issue bond, and the bond that use the mortgage to pay to the investors. Okay, the investor will get exactly the cash flow like the banks who receive every month from the home buyer before. The bondholder will get exactly the same. Okay, usually the bondholder, we're gonna issue bond, and this bond we call mortgage-backed securities. The way you transform the illiquid asset of the bond at the time you issue bonds, okay, you're gonna get proceeds of the bond, and then the bank will gonna receive cash from selling this bond or selling this mortgage to the SPV. Okay, you can see that how you can transform, converting your illiquid asset, which is mortgage, into cash. And then the SPV, which is another identity, okay, we're gonna hold the mortgage on behalf of the bank. So the banks is not anymore the owner or the lender of the home buyer loans, right? So the HPV becomes the owner of that mortgage, a kind of like, but they still use bank as the service and the servicer, and the bank will receive money from the home buyer as before, but they're gonna give back to the SPV, and the SPV gonna use cash flow to pay to the MBS holders. Okay, that is how we do securitization. All right, so let's go back to our business. So you have this season equity offering, and then you can have season mortgage. We can securitize. You can use student loan. You can use car leasing. Whatever you see the cash flow, you can securitize it. When you use mortgage, we call MBS. When you use other asset, we call asset backed security, we call ABS. Yeah. So let's go and talk a little bit about how we can raise equity capital in in the capital market. The initial capital that's required to start a business is usually provided by the entrepreneur, by immediate family. Okay, yesterday we're talking about how to get the money from your father-in-law. Okay, so often a private company must seek outside sources that can provide additional capital for growth. It is important to understand how the infusion of outside capital would affect the control of the company. Okay, if you don't get money enough from your immediate family, okay, your cousin, your family members, and so on and so forth, in the US or in Europe, I think in Vietnam you may also have more and more people who play as what we call the angel investor. The angels, okay, are individual investor who buy equity in small private firms. Finding angel is typically difficult in emerging markets, but in advanced economy like US or Europe, it's not too complicated to find angels if you have a good projects. After the angels, you can also find some kind of venture capital, the VC, okay, or which is a limited partnership that specializes in raising money to invest in the private equity of young firms. So they invest in equity, okay, of the unlisted young company, high growth company. And then they have the venture capitalist is one of the general partner who work for and run a venture cap firm on behalf of other venture capital investors. All right. Venture capital firms offer limited partner advantages over investing directly in startup themselves as angel investor. Limited partner are more diversified, so investor can invest in different venture capital funds, so you can diversify. They also benefit from expertise of the general partners. Many of these VC are the experienced investment bankers, experienced manager who run already a company in the sector and so on and so forth. So they have those kind of expertise that help to manage those companies. The advantages come at cost. Obviously, the general partner usually charge substantial fees. Most firms charge 20%, for example, of the return made. They also generally charge an annual management fee for about 2% of the fund committed capital, okay, before they exit. So this is a kind of venture capital funding in the US. As you can see, the number was exploding in 2000, and then it's calmed down a little bit, and then you go to approximately 40 or a billion, which is about or 40,000 deals over the period of 2003 to 2011. That is about the VC. The VC invests in those kind of startup companies. You have also we call the private equity. I have already discussed yesterday. Private equity firm organize very much like a venture cap, but they invest in equity of existing privately held firms. They are quite mature. Rather than startup company. Private equity firm initiate their investment by finding a publicly traded firm or the private firm and purchase the outstanding equity, thereby taking the company private in a transaction we often call leverage buyout. In most cases, the private equity firm use debt significantly as well as equity to finance the purchase. But the big portion of debt if they do the LBO transaction. This is a kind of volume, as you can see after 2008 crisis. Okay, the the LBO volume went down significantly, and then is moving up again after year 2009, and it's still super active this day. These are the name of the private equity funds you may have heard. Okay, Blackstone, for example, is super active around the world right now. You have TPG Capital, Goldman Sachs, Principal Investment. You have, Bain. You have CVC, and so on and so forth. Okay, these are the top private equity funds. Apart from those VC, PE, and so on, you have also institutional investors. That's institutional investors such as pension funds, insurance company, endowments, foundation are active investor in private companies. Somebody know what is a pension funds? Yes? Somebody know what is a pension funds? Do you have a pension fund? Public pension funds can be private pension funds. Somebody know what's a pension funds? Can you give me 1 minute? Somebody call me. Just 1 minute. I get. So yes, the pension fund is the fund for, saving for your retirement. So when you get retired, you're gonna get those money back, okay, every month in your the pension program. And the fund manager who manage the pension fund, we're gonna invest your money in the capital market, and then they invest also in the stock market, and so on and so forth. Okay. Endowments. What is the endowment? Somebody who is the endowment? Somebody know what's the endowment? Somebody know what is the endowment? So the largest one is the Harvard University endowments. So many of these top big university, you can have some kind of endowment, okay, that many donators. So for example, if you graduate from Harvard and then you are successful, you become rich, or even not you become rich, it's very custom, tradition in the US that after you graduate, when you earn something, you can probably get back and donate some money to your university or school you graduate. Okay, and the university will keep that funds and invest it and use those endowments, okay, to to finance scholarship, sometimes to pay professors, and so on and so forth. So these are in the US is a very, very big, some of the funds that have very big You have also kind of sovereign fund. Have you heard something sovereign funds? What is the sovereign funds? Sovereign fund, for example, you have Qatar sovereign funds or Singapore sovereign funds, which is called Temasek. Have you heard something about Temasek? Do you know what the Temasek is? A fund held by the Singapore government. The government who manage the fund and invest, that they invest in stock market in Vietnam, in Bangkok, in Thailand, in the US, and so on and so forth. It's a kind of very big fund that invest in the capital market and so on. And then you have a corporation. The corporation invests in a private company. There are also some, they sometimes they invest in private firm. For example, those GAFA company are big corporate investors. Somebody know GAFA? When they're talking about the GAFA, do you know that? These are the big corporations. Who are they? You know GAFA? Somebody know GAFA? Not heard about it. Anyone? The people talk a lot on these GAFA plus M, which is almost dominate the whole economy, world economy these days. Google, Apple, Facebook, Amazon. Perfect. And then you have also Microsoft, which is about, and then these are like huge tech firm. And these huge tech firm become so powerful. And then many people, a lot of politicians believe that it may be too powerful. So they don't want these people, for example, the big tech firm in China, like Alibaba, Tencent, all these were attacked by the Chinese central government, the Communist Party, that they're trying to reduce, to mitigate their power. They are so powerful, they are too powerful. Same for the US, that a lot of politicians these days, if you listen, international news, you can see that a lot of politicians criticize the power of Google, Apple, Facebook, Amazon, Microsoft. They are now super big, that even bigger than the mini economy. If I take the total GAFA market cap, you can see that is almost, not almost, it's bigger than the whole Southeast Asian economy, if you take only the GDP of those. Okay, so that is a kind of a very big tech firm, and those big tech firm, they are super active. They do acquisition all the time, like to get new innovation and so on and so forth. Okay, so we have obviously the preferred stock holder. The preferred stock issues by mature company usually has a preferred dividend and seniority in any liquidation, sometimes spatial voting right, but most of the time you don't have voting right. Preferred stock issued by young company has seniority in any liquidation, but typically does not pay regular cash dividend, often contain the right to convert to common stock. And this is called convertible preferred stock. Okay, that give you an option to convert into common stock or some future date. Okay, then you have we call the pre-money valuation, post-money valuation, and the The pre-money valuation is at the issuance of the new equity, the value of the firm prior shares outstanding at the price in the funding round. And the post-money valuation is the issue of the new equity, the value of the whole firm, I mean old plus new share at the price the new equity sold. And this is the way you're gonna be able to determine what is the amount invested when you make a round of the new fundraising. And then you obviously are talking about the exit strategy for those PE firm or the VC. It detail how investor will eventually realize the return from that investment. Investor exits in two ways: through a trade sale. You can sell to those GAFA companies, or you can simply go to the IPO, or to or when you sell, you can sell to anyone, right? And then IPO, you can even go publicly. Okay, so let's give example how the fundraising, I think it's gonna be interesting for you guys to get some idea. The calculation is very straightforward. Just wanted to give you some idea that how it works. So if you are the startup, or you plan to become, or you have already had your company, and you want to get more raise finance fundraising to make your company bigger and finance the growth to become global company, and so on and so forth. Let's assume that you founded your own firm 2 years ago. Initially, you contributed $100,000 of your money, okay, in return, and you receive 1.5 million shares of the stock. Okay, so far so good. Since then, you have sold additional 500,000 shares to angel investors. You are now considering raising even more capital from venture capitalists. The venture capitalist has agreed to invest $6 million with a post-money valuation and $10 million for the firm. Assuming that this is a venture capitalist's first investment in your company, what percentage of the firm will she end up owning? What percentage will you own? What is the value of your shares today? You follow? Okay. 2 years ago, you founded your company, you put $100,000, and now you want to know how much you own of the new value of your company. Because the VC will invest 6 million, right? So VC going to have the 6 million out of 10 million post-money valuation. So therefore, her ownership percentage was gonna be 60%. The P-money valuation is 4 million. Okay, as there are 2 million pre-money share outstanding, this implies that the share price was gonna be $2 per share. Therefore, the VC will receive 3 million shares for their investment. And after this funding round, there's gonna be a total of 5 million shares outstanding. It means that you own, right, the original share that you own 1.5 million share. Okay, after this round, you're gonna own 30% of the firm, okay, of the post-transaction valuation of your share of 3 million US dollar. Okay, so that is how we do some kind of don't worry too much on the calculation. It's easy to understand. You can review it later on, but only to get some idea how thing goes. Okay, how the value of those startup company or startup investor after you succeed on the you are successful in fundraising. You can see the value of your shares goes up when you sell it to the new investors. In this case, they sell it to the VC. All right. So I just want to talk next on the IPO, just to get you some ideas about how we do an IPO. Have you ever participated in any IPO? process. The IPO is a process of selling stocks which are privately held, okay, to the public for the first time. Why we want to do an IPO? Because the IPO, we're gonna make stocks available for trade, and you're gonna improve or make the greater liquidity of the stock. So the private equity investor get the ability to diversify, to buy and sell and trade, and this give advantage to the firm. You have also advantage to participate to raise fund in the capital market that allow you to have a better access to the capital. Public company typically have access to much larger amount of the capital through the public market. You depend less on the bank loans or commercial banks to finance your company, the company growth. Disadvantages is that the equity holder become more widely dispersed. This makes it difficult to monitor management. The firm must satisfy all the requirements of public companies set by the Security Exchange Commissions. Okay, and then obviously regular report, obligatory report on the those public company. They are more more demanding than the privately held companies. All right. So these are the kind of large global equity issues that you may know. This is a little bit out of date, a little bit old now. And as you can see, the underwriters. Who are the underwriter? Underwriters are the investment bankers. So most of our students in finance at the SCP, they work, as I told you at the beginning of the class, in these kind of investment banks, okay, who do the underwriting. So underwriter is an investment banking firm that manage a security issuance and design its structure. You can do the primary offering, new share available for in the public offering that raise new capital, and secondary offer, one share sold by existing shareholder to an equity offering. So how the underwriter, how we gonna, let's assume you are an entrepreneur. You can hire underwriter, okay, investment bank who gonna sell your shares. So investment banker is or underwriter is a salesman, right? They can do as an intermediary of selling shares to the investors. How they do? They can do in different bases. For example, they can do base efforts basis. For example, small IPO, you can have a situation in which the underwriter does not guarantee that the stock will be completely sold, okay, but instead try their best. Okay, often such deal has an all or none clause that either all the shares are sold on the IPO or the deal is called off. Okay, they suspend and stop when the market is bad. They can do also firm commitment, which is an agreement between an underwriter and issuing firm in which the underwriter guarantee that it will sell all the stock at the offer price. If they cannot sell, the underwriter need to take all those shares at the agreed price. What we can do also, we call the auction IPO. I think in Vietnam, when you do some state-owned enterprises who do the, partially privatize their shares, often they do the auction IPO, the method of selling new issue directly to public and setting a price itself from the auction market. Okay, people bid for investor and set the price, then they clear the market. How we do the IPO pricing auction basis. For example, Fleming Educational Software is selling 500,000 shares of the stock in an auction IPO. At the end of bidding period, the Fleming Investment Bank had received the following bids: $8 for 25,000 shares, 7.75 for 100,000 shares, 7.5 for 75,000, 7.25 for 150,000, and so on and so forth. What will the offer price of the share be? You are going to sell 500,000 share. What should be the final agree price from these bidding information? Anyone? Anyone can answer? So the idea, if you agree at the 8, you're gonna be able to sell only 25,000. If you accept at the price of 7.75, you're gonna have 125,000 share to be sold, right? The people who bid at 8, they're gonna get also 7.75, isn't it? Okay, they would not agree to pay at 8, right? So what's going on is that, for example, you have all these 125,000 share at 7.75. If I use this one, I get 125. Fleming is offered a total 500, so you have to go until $7 per shares or not, okay, or higher. All investors who place bid at least this price will be able to buy the stock for $7 per share, even if the initial bid was higher. Okay, this is how we do the auction IPO. Okay, so how we we underwrite, okay, underwrite and syndicate. So when you have like big IPO, you can have lead underwriters. They can form a group of people who can help to sell the issuing shares, okay, and then the main one we call lead underwriters, okay, and then a group of underwriter who jointly underwrite and distribute security issuance we call syndicate. And this is an example of the global IPO offering. This is a little bit old now, for 2011. As you can see, all these are the top investment banks: Goldman Sachs, Morgan Stanley, Deutsche Bank, Citi, Bank of America, Merrill Lynch, where I worked it before, and so on. Usually, not usually, in general. So what you have to do is you have to hire these investment bank who also help you to prepare the administrative filings to get approval from the authority. The authorities that supervise these share trading or stock market, we call the Stock Exchange Commission. This stock exchange commission, they can have some legal document. They require legal document that provide financial other information about the company to invest before security issuance, and then they're gonna do some preliminary prospectus. After you get preliminary prospectus, you're gonna do the kind of roadshow. Have you heard something about roadshow? Okay, so they're gonna travel close to the investor. They organize the presentation and meeting to see how the IPO, how the company look like, what are the future of the company, what they do, main business, and so on. And then after, the potential investor may give some kind of intention on how many stocks they want to buy, okay, and they give to the investment banker, and then investment banker complete all those information and make a final prospectus of the company IPO, and then make it the number of share offer and the offer price in this final prospectus. This is an example of how the common share are issued. That is a first cover page on the IPO. Okay. There are two ways to value a company when you do the IPO: to compute the present value of estimated future cash flow, for example, using the DCF, discount cash flows model, and then estimate the value by examining the comparables. Otherwise, okay, you can take some of those different type of ratios of comparable, and you're gonna make those valuation based on your comparables. You do roadshow during an IPO when a company senior management and underwriter travel around promoting the company, explaining their rationale for an offer price to the underwriter largest customer, mainly institutional investors such as mutual fund, pension funds, and so on. And then you make the process of we call book building that underwriter will going to use to come up with the offer price that ensure that all the share they're going to issue will have potential buyer who going to take that share at the time of the IPO. Okay, so you can do some different type of comparable price to earning, price revenue, and so on and so forth. And this that you can, I don't need to go detail, you can read it, okay, but it's very straightforward to have this kind of comparables of the firm in the same industry where you believe that these firms are comparable firms to the firm that you are going to do an IPO. Okay, all right. Pricing the deal and managing risk. So since the underwriter take a risk, okay, to sell the shares, okay, if they agree with the existing or the shareholder to sell, so therefore they want to ensure that they are able to sell. If they have already provide those commitment, is potentially exposing itself to the risk that the banker firm might have to sell share at less than the offer price and take loss. So the researchers, find some interesting that 75% of the IPO experience an increase in the share price on the first date. Only 9% experience a decrease when you have these IPO price go up on the first day. Okay, it can be also considered as a bad deal when it's increased too much. It means that the valuation and the price, the offer price on the IPO is underpricing, isn't it? And therefore, the previous investor who sell the share before an IPO will take the loss from that one, right? Now, what is the pricing deal and managing risk? So in general, we have, when in the IPO, we have over allotment allocation. We have also, we call green shoe provision. In IPO, for example, the investment banker may get an option that allow them to issue more stock, for example, more than 15% of original offer price if the IPO is successful and they have more demand on the shares than they are planned on their planned number of share they're going to do an IPO. In that case, in an underwriter, investment bank can make more money to issue more stock than they expected. Obviously, the company also will get more fundraising than the amount that they originally planning to have. Underwriter initially market both the initial allotment and allotment in the green shoe provision by short selling the green shoe allotment. So all these I would suggest you to read. The underpricing, as I told you, underwriter set the issue price so that the average first day is positive. When the average, the underwriter benefit from this underpricing, okay, but the pre-IPO shareholder bear that cost of underpricing. The average first day return in the US is 18.3%, and the average, for example, the underpricing in the China or in emerging market even bigger than the IPO in the US. Okay, this is a third example of the statistics, and you can see China, India, Malaysia, Korea, and so on and so forth. This is information. Where is Vietnam? Do we have Vietnam here? Sri Lanka, Singapore, Poland, Cyprus, New Zealand. Unfortunately, we don't have Vietnam IPO data here, but I think it should be in this group as well, right? The group that have more underpricing. Although IPO return are attractive, all investors cannot earn these return. When IPO goes well, the demand for stock exceeds the supply, then the allocation of share of each investor is rationed. When an IPO does not go well, demand at the issue price is weak, so all initial orders are fired completely or filled completely. The typical investor will have their investment in good IPO ration while fully investing in bad IPO. The number of issue is highly cyclical. When time are good, the market is flood to the new issue. When are bad, the time of issue dry up. So they have a lot of study on the market timing on issuing shares and do an IPO. They can have like hot period of the IPO, cold period of the IPO, and so on and so forth. So therefore, the timing, the choice of the timing can be very, very important. This is an example of information from the US. And the cost of the IPO, the typically spread 7% of the issue price. Okay. And also the many research show that the long run underperformance of the IPO. Okay, most of those IPO in long run, 24-month return or 36-month returns after the IPO, they underperform in relative to other comparable firms. All right. So this is a kind of information about IPO, as I told you, is just only a lot of descriptive thing that you can read it from the book or you can review from my slides. Okay, there's no complication on that. On my exam, I'm gonna do something mostly in the true and false question or some descriptive questions on this. Okay. By the way, I will do the open book exam. Is it okay for you guys? You prefer open book or closed book? Do you prefer open book? You say it depends. If I have open book, the question should be not too directly, but it should be more complicated than closed book. But the closed book, the the exam would be straightforward and simpler than the open book. But since you do online, I would guess that it's very difficult to control whether the exam is closed book and then you're not open book or find some information here and there. So I think we have no choice to make it as an open book, I guess. No? What about other exams? You all do open book? Other exam? How did you do it? Did you do open book or closed book? The most recent exam is open book. Okay. Okay, I think I would do open book because it's too complicated to do a closed book exam online. Okay, to make it fair to everybody, I think I would try to do it open book. Anyway, on the 29th of September, I can tell you in advance. I can tell you everything about the mode or number of questions and the structure of the exam. I still have few slides to go. It's gonna be super fast. So you can do also season equity offering when public company offer new share for sales. The public firm use season equity offering to raise additional equity. When the firm issues a stock using an SEO, it follow many of the same steps as an IPO. The main difference is that the market price for the stock already exists, so the price setting process is not necessary. Okay, so the primary share, secondary share, I've already talked about it, and they have different way to do the SEO, the season equity offering. Either you do cash offer, is a type of SEO in which a firm offers the new share to investor at large, or you do what we call the rights offering. What is the right offering? The right offering is a type of equity offering in which a firm offers new share only to existing shareholders. Okay, they give the right to the existing shareholder to buy new shares. Okay, and if you don't want to participate, you have the right to do so, because right is an option. And rights offer protecting offer protect existing shareholder from underpricing. Okay, this is the example of right offering. I would like you to probably look at by yourself. Okay, the researcher have found that on average the market greets the news of SEO with a price decline. Remember when I talk about the market timing hypothesis of the of issuing new share, usually since the company may choose to issue new share when they feel like, at the time when they feel like the market price is overvalued. So therefore the market can react based on those equity offering or SEO announcement, okay, to make the price goes down. All right. So this is the example of the post CEO performance. You can see the information look very interesting. Okay, that they are usually underperform in these type of returns. Although not as costly as IPO, the SEO is less expensive. The fee can, amount to 5% of the proceeds of the issue. Usually, right offer have lower cost than cash offers, because right offer you just simply go to the existing shareholder. You don't need to go to public. You don't need to go to make the road show to get, new investor to buy shares. All right. So that's it for all the introduction. I would suggest you to review and read this chapter 12, 23 one more time from my slide or from the textbook. And then if you have time, you can read other chapter as well, even though it is not part of the exam. The exam will cover only these 6 module of my slides. Okay, so meaning what? Meaning that the exam we're gonna cover the capital market and pricing of risk, how we compute the volatility of stock, that we measure total risk, and the total risk has the idiosyncratic rate and market risk, and we learn on the how to optimize portfolio choice, how to choose the efficient portfolio, and the CAPM, and estimate cost of capital, cost of equity capital, cost of debt in chapter 12, and then capital structure in a perfect market, Maudie Miller proposition number 1, number 2 in chapter 14. And then we introduce market frictions like taxes, financial distress costs, and the way you trade off between interest tax shield and in the financial distress. We call the trade-off theories, and agency costs that can be, that can use as the discipline manager, and so on and so forth, which is chapter 16. And then we have chapter 17, which is about the payout policy, and then chapter 23 on long-term financing, that I cover only equity long-term financing. You can read that long-term financing, but I don't feel like it's interesting to explain in class, but you can read it, or you can have direct experience and read it by yourself. Is it clear? The most recent exam is open book. Yes, I agree, because the open book is more adaptable in the setting of the online exam. Okay, but in France when I do the online exam, we put the function where we not allow you to go back to the previous question. So it means that the student cannot share the question and answer to their friends, because each one will see the question from the pool of the question, not in the same order. Okay, so if you have already seen that one, it's more difficult for someone to, to cheat on it. So I'm gonna discuss all these later on. My classmate want to go to whichever exam is easier. Okay, I will let you know. Okay, I will let you know what is the best. The idea for me is I want to make it fair, and then I don't mind to give you good grades. Okay, if you want to get 20 out of 20, you just simply write to me, I give you 20. It's a joke. Okay, so ideally is I gonna try to make something reasonable. You understand the main concept that we have studied, and that's it. Okay, usually I will make it reasonable, so that you have less fail rate from the exam. So it should be fine. Everything should be all right. Okay, do you have any other questions? I hope you can come in Paris. Normally you come in May, right? In year 2022. Hopefully that the COVID's gone away. I'm not sure whether they have, after Delta, they have maybe other thing, we don't know. But hopefully it would be great to meet you in person in Paris. Otherwise, normally I'm discussing with Madame Lin right now on my next class, which is called international finance, which is more kind of advanced corporate finance, where I gonna do some forex, and then I gonna do some international cost of capital, and do some project financing or financing in emerging market. Normally it's gonna be in December if something's go fine. I'm not sure whether Vietnam is open at that time or I can travel. If I can travel, I would love to go to Vietnam, because I would like to eat pho. I would like to get to eat bún bò and phở bò for my favorite. Or bánh chao, I love it. My wife also love it. And then we gonna be, but I'm very pessimistic about December situation. But otherwise, I'm gonna meet you in May 2022. Yes, very happy to see you guys. So I have a question, Professor. I want to listen more about post-money evaluation. How do you define this term? What is the process in the real business acquisition? That is very interesting question. That the idea is you have to come up with the valuation model, okay, to get, when after the company have a future business plan, when they have those predicted cash flows, then they often use those comparables together with the DCF, and they make the kind of firm valuations. Okay, at each stage of the of the firm valuation, so you're gonna try to get at the time when you go the new round of financing, you're gonna need to get all information to evaluate and try to find out what is the future cash flow of your new project on your financing plan. We're gonna generate the future cash flows, so therefore you can make it to make the post evaluation, post money valuation. And this post money valuation is a very very subjective in some sense, but it's not subjective because you try to quantify it. But at the end, we're gonna be the negotiation between the VC firms and you, or sometimes it's a VC that is discuss with the previous the angels, okay, who have already participated earlier before the VC and so on, right? But how we do the post money valuation, the answer would be exactly how we do the valuation, firm valuation to do an IPO, the same thing, right? So what is the amount, what is the value that you believe that it should be a good market price for the company to do the acquisitions? It is okay. Guyan Hong Lin Bill, do I answer your question? Okay, sir, thank you. Do you have any other questions? Today, as I told you, we don't have break, so we finished a little bit, we quite earlier. Okay, so I hope you enjoy my sessions. I'm so happy to be with you. Okay, I'm very happy to be with you and to share my experience, to discuss with you, to introduce you some new concept of corporate finance. As I told you, this is a kind of introducing you on modern corporate finance that you need also to learn more. Okay, starting by learning about the beta, try to observe, try to understand the real, and then by the way, on 29th, okay, please prepare. I'm gonna send my slide immediately to Lin and Tan so that she can upload it. Or I can upload it. Just wait 1 minute. I can probably upload it directly to this. Just 1 second. I have file. I can upload Euro problem set solution. Problem set solution. Okay, so you have it now. You have the solution now. Okay, of all the questions we have done together in the problem set. Okay, so if not, thank you very much for your participation. I'm so happy to have you. I hope to see you in person soon. If not, we will see one day when I go to CFVG in Vietnam, in Hanoi or Ho Chi Minh, and hope to see you around. And then otherwise, if you come next trip in Europe, I will meet you here in Paris. Okay? Thank you so much to be with me and spend time in the evening with me. And please prepare well for your exam and keep all the question you may have if you want me to answer on 29th after you study a little bit. Okay, and then I wish you a very nice evening and stay safe from COVID, and take care yourself, take care your family, take care your girlfriends, take care your boyfriends, take care your husband, take care your wife, take care your family. Thank you to you all, and hope to see you very soon. And very happy to maîtresse. No, it's not allowed. Thank you. I love this course. I also love my student here. So I love you all. It is great to be with you. It is great to have the breaking time with iPhone view, and hope to see you soon. Hope the situation of COVID becomes better, which is not exactly the case. Now we also found that the vaccine is not exactly as we expected. We may need to get the third dose and so on. Thank you very much again, and enjoy your evening. See you soon. Bye bye. See you on the 29th of September. Very important. Please come, okay? Because I'm gonna talk about the exam preparation and all the answer all the question you have. If I have something to send it to you, I can upload it on this Canvas for more exercise with solution so you can study more. All right. Otherwise, I would say bye bye to you guys. See you. Bye bye.
You are currently the only person in this conference.